South Africa's net debt is expected to rise from 48.6% of GDP in 2017-2018 financial year to 52.2% of GDP in 2020-2021. S&P has warned that fiscal deterioration due to higher expenditure pressures and weak economic performance could sink the country's ratings further. State-owned enterprises continue to pose significant risks to government finances as contingent liabilities. The public sector wage bill is another risk to the fiscus.
The contingent liabilities, I think there is a lot that needs to be done within the SOE space, particularly Eskom, just because it's so big. But aside from that, the budget itself looks very much in line with what our finance minister was telling us recently. It should be okay going from the February budget this year to the October medium-term budget. But one thing I think we're all keeping our eye on is the public sector wage bill. Those negotiations have not yet concluded, and even if they do conclude at the levels that were set now by government, this would actually be in excess of what was budgeted for in February. And that basically means that Treasury has to find a way to contain that expending without allowing it to widen the budget deficit.
Some say policy uncertainty could derail investor confidence, reversing the gains made in the changes in leadership.
The biggest limitation to growth, of course, is a lack of confidence, lack of trust. So we need policy certainty to restore confidence, to restore trust, so that the economy can benefit from higher investment, and at the same time, through higher investment, through higher economic growth, we'll make inroads into our very serious unemployment problem. Mr. Ramaphosa and his administration has done a lot to restore trust after the Zuma chaos we've experienced, but more must still be done.
Rasool warns there is a possibility of even higher taxes in 2019 in a bid to increase revenue. Claudia Safako Musi, SABC News, Johannesburg.